Should you refinance your mortgage? When rates lower and we hear everyone talk about a refinance boom, it can be really hard to decide, should you refinance now or not? And here's the big issue is everyone's telling you to refinance. Lenders, realtors, the news, but no one's giving you the opposite side. So I want to break down and help you understand, should you refinance? We're going to talk through the exact formula that you need to know, along with some common refinance strategies. My name is Kyle. I'm a loan officer. My website is winthehouseyoulove.com. Let's go ahead and dive into this. So first, we need to know, understanding, why does everyone keep talking about refinances all the time? When news about refinances come from the news, we have to understand that what they want is they want viewers. They want to get people's attention. So they're going to use as alluring information as possible to get you to come to their website or watch a video. They want to get your attention. So they're usually not a great expert on it. They want to stir up emotion. So know that they want views. And lenders and realtors alike, what do they want? Refinances, because that makes them money. So we can see the people who are talking about you needing to refinance are the people who benefit from you either having an emotional reaction to it or from refinancing. So these people are very biased in their opinions about if you should refinance, right? So just know that it's a bit of a one-sided conversation if you see everybody talking about refinancing. So don't go off of the emotion just because everyone in the market is saying refinancing needs to happen for you. Because if these people are saying yes and they're biased, who's the person that's saying no? So how do we actually tell if a refinance is good? Here is the formula that you need. You're going to take your monthly savings divided by the cost of the refinance to see if it's worth it. What this is going to do is show you your break-even point. So for instance, let's say right now your monthly payment is $1,000 on your mortgage. And let's say you could refinance and you could drop that to, let's just say $800 per month. Okay, so you saved $200 per month. All right, now let's look at the cost of the refinance. What you need to do is talk with some lenders and see what does it cost to refinance. So you might have an appraisal, you might have things like title fees, recording fees, you might have prepaid interest, there might be some other fees involved in there. Let's say the cost of your refinance is $2,000. Now this $2,000 might be being put into your loan amount or might be paid up front. But if we get this, we can see that we have a break-even point here of 10 months. So we know that in 10 months, you broke even on your money, and then from there, you're benefiting $200 every single month. So what this helps you do is see if is it worth it based on how long you're going to be in the house. So if I'm going to be in the house for 10 plus months, maybe a year, 2 years, 3 years down the line, then a refinance in this situation makes sense, right? I passed the break-even period, and now I'm profiting afterwards. But if your break-even period is a lot longer than you plan on staying in the house, the refinance is absolutely not worth it. I see people do this all the time where they see a lower rate and they equate that with savings. And if you're not looking at the total picture of everything involved, you're really missing out, because a lot of these big lenders, the ones that like to advertise on the Super Bowl, I'm not going to mention who they are, but what they like to do is they like to charge points, which are prepaid interest. So you pay an upfront cost to lower your interest rate. All right, so maybe you were at a 4% interest rate and then you paid $5,000 to lower it to a 3% interest rate. And then they take that $5,000 and they wrap it back into your loan. So all you see on paper is a 3% interest rate. That sounds great to me. Let's do it. But in reality, you just took $5,000 and financed it back into your loan. You're spending all this time paying off debt, all for it to be shoved back into a loan. And lenders like when you do this because they profit off of it. They profit off of you not knowing. They profit off of you only looking at the interest rate. You have to look at the break even. You have to look at the whole picture. So this is the simplest formula to see, is a refinance going to work for you? It does not have to get more complicated than this. Take your monthly savings divided by the cost of the refinance. That's how many months it takes to break even. Are you going to be in the property longer than that? Great, refinance makes sense. Are you going to be in the property shorter than that? The refinance doesn't make sense. It is as simple as that. Okay, so you have to know if that break even makes sense. Something you need to watch out for is extending your loan term. So let's say you got a 30-year loan and you got that 7 years ago. So you now have 23 years left to pay down your mortgage. So in 23 years, you are mortgage free, which is awesome. What people will do is they'll take their 23 years left on their mortgage, refinance it into a 30-year loan. Okay, so we just took our debt, our money that we spent a long time trying to pay down and pay down and pay down, and we just extended it another 7 years. So you have to be careful that if you have a 23-year mortgage, don't add 7 years on top of it and stretch it out to a 30-year. If you have a 23-year-old mortgage, or I'm sorry, 23 years left on your mortgage, refinance into a 23-year mortgage. You absolutely can do that. It doesn't have to be a 30 or a 15. You can refinance to a 30, a 29, a 27, 26, I missed 28, 25. You can do any number that you want. Okay, you could do a 5-year mortgage, 6, 7, an 8, a 9, a 10, 11. You can do whatever duration of mortgage that you want to. All right, watch for the points added into your loan amount. Lenders love to do this, especially these big retail lenders that function more like call centers than effective loan company. What they like to do is they like to charge points. And the reason they get away with this is because people don't really look into it that much. So what points are the prepaid interest that helps you lower your interest rate. So you pay some money up front and it lowers your interest rate. Now, points are not bad in of themselves if you use them properly. The problem is a lot of lenders will charge 2, 3, 4 points, which is 1% of your loan amount, and then they go and put it back into the loan amount. So it doesn't really affect you up front because it's paid in the loan. You don't actually have to bring that money to the closing table. So people don't think about it. It doesn't have any material weight, but that's money that you end up paying back over a period of time, and it's not a good decision. So watch out for points added to the loan amount. Also, something that's super beneficial, if you have a government-backed loan, so you have an FHA loan, a VA loan, or USDA, you can do what's called a streamline refinance. So streamline refinance means that you don't need an appraisal on your property, and you don't need what's called a credit package, meaning the lender doesn't have to verify income and your credit history and everything like that. If you refinance with a conventional loan, then you have to have an appraisal and a lender has to look at income and assets to make sure that you're still able to qualify for the loan and the property still has a good value. But with these types of government programs, there's no appraisal and no income that has to be verified, which is super awesome. These are loans that you can close super quickly. Like you could close them in a week because they don't require really a lot going on. As long as you've made your payments on time for the past 12 months, you should be good to go with that refinance. There is a seasoning requirement, meaning you need to have had at least 6 monthly payments on time. And you also need to make sure that there's been 210 days passed since the closing of your loan to a new refinance. So let's talk through some common refinance scenarios. So here are circumstances where it might be beneficial to refinance. Number one is when rates drop. All right, so the market's fluctuating and changing all the time depending on tons of different economic factors. And sometimes mortgage interest rates drop significantly. So you might have got your interest rate at 5% and now interest rates are at 3.5%, and it might make sense to drop your rate. Again, you're looking at your break-even period there, but when rates drop, that benefits you and it's a good time to look at refinancing. Also, you could refinance when your home value increases and remove mortgage insurance if you have it. So if you have mortgage insurance, you're paying mortgage insurance because you have less than 20% equity in your home. But if your home value goes up, you might be able to have all the equity that you need to drop mortgage insurance. So that could be a good chance for you to remove the mortgage insurance and see, is it worth it to do the refi or just continue paying down on your mortgage? Also, this is the one that a lot of people don't know. If your credit score increases, absolutely refinance into a better loan. Interest rates are given based off of your credit score. So the lower your credit score, the higher your interest rate. The higher your credit score, the lower your interest rate. So I've had clients who we started when they got a loan initially, they're at a 600 credit score. Okay, so they were in an FHA loan and their interest rate wasn't the greatest because it's a 600 credit score. And after 6 months to a year, they were able to build their credit score up to a high 600. So then we could look at refinancing into a streamlined FHA, so giving them a better rate simply because they have a higher credit score, or even flipping them over into a conventional loan, which is going to be a lot better. You could also refinance into a shorter term. This is going to save you so much money. So if you have a 30-year loan, you could refinance that into a 15-year loan. Or maybe you have 23 years left on your mortgage, refinance that into a 15-year mortgage or a 10-year mortgage. That's going to help you save so much on interest, and those shorter loan terms actually have lower interest rates than the longer loan terms. You could also refinance into a better loan. So this is what I'd like to teach a lot with FHA loans. FHA loans are great starting out, but they're not loans you want to keep for a long period of time because they have lots of mortgage insurance packed into them that usually doesn't go away. So normally what I suggest is someone who has an FHA loan right now, maybe they were at a 600 score. Okay, well, if we build up that credit score over a period of a year or two, get it up to 720 or above, then we could refinance it into a conventional loan and save a lot of money on our interest and on the mortgage insurance. You could also do a cash out. This is a little more uncommon, but maybe you want to pay off debt with your mortgage. So you have some money sitting in your home equity, maybe $100,000 in home equity, and you want to pull that cash out and pay off some debt. That's absolutely a strategy. Or you could use a cash out to use towards an investment property. Or some other investment that you want to use. So maybe you want to pull cash out of your property, do a refinance on it to then use that money on an investment. Ultimately, refinance quotes are free, okay? It costs you nothing to go talk with a lender and get an idea of how much you can save and how much your costs are going to be so you can see a total picture of what your cost savings are going to be. All right, there's so much noise out there with information about rates and refinancing and what you should and shouldn't do, and it's all coming from biased sources. Ultimately, you need to make the call on if a refinance is going to be a good choice for you. And it does not depend on just the interest rate. It's going to come down to that break-even formula. Does it make sense for you and your family to move forward with an interest rate based on how long you're going to be in that property? Okay? This should give you a very clear idea of what you need to do to understand if refinancing is a good idea or not. In the description are some of the states that I'm currently licensed in. If you want me to give you a quote on a refinance in that state or a purchase in that state, let me know, reach out, and I'd love to help you out. Let me know if you have any questions in the comments. Thanks so much for watching.